Dear students, it is time for us to discuss fees. How are we being charged as mutual fund investors? Now, I recommend to you that you print the study guide or at least have a notebook with you because we're going to go through several what are called share classes. And I'm serious. We want you to understand these and know them thoroughly. And you're going to find that they're just, again, the tip of the iceberg. But after we've gone through these several share classes, you will find that the others are all variations on a theme. Okay, so you ready? Be prepared. Have your notebook or that study guide with you, because we're going to go through the various ways that mutual funds charge their investors. All mutual funds have what are called annual operating expenses, and they fall into three categories. The management fees, which typically are the largest portion, and this is the money that is paid to the portfolio managers, the research analysts, the people with the top hats. And again, if they're doing it correctly, it's not inexpensive to research companies. It's a very labor-intensive, from highly skilled individuals job. So be prepared. Now, we're going to discuss again index funds, which are exactly the opposite of what we're talking about, where the managers really don't have to do anything. The next category are 12B1 fees. What a stupid name, but it comes from the Investment Company Act of 1940. And this is an annual fee that is used to defray advertising, servicing, distribution costs of the fund. It can get pricey. Now, does Coca-Cola tell you how much they're spending on advertising? Or Toyota? Or your banks or life insurance companies? No, but mutual funds via the Investment Company Act of 1940 are required to tell you how much they are charging you for their marketing. The next category is accounting and other expenses. Pay the rent, pay the website, and all the other expenses that come with running a mutual fund. So these are the three annual operating expenses. Now notice that there's a little line here between the first three and the fourth one. The fourth fee is a trustee fee, and that is typically only for what the IRS calls tax qualified accounts. Retirement accounts, health savings accounts, educational savings accounts. And why is that? Because with those types of accounts, the IRS requires you to have a trustee to hold the money. You're in control of it. Don't worry, folks. But the trustee must hold the money and has certain fiduciary duties that the IRS requires of them. And you typically pay $10 a year, upwards. I've seen it as high as $100, but usually it's $10 to $20, $30, $35 a year. Okay, and that's only for retirement accounts and other tax qualified accounts. So we'll forget about that one. But we will discuss the other three in detail. Now, on slide 22, we see that there are trading costs. This is interesting. They're not disclosed in the annual prospectus. So how does an investor know how much the trading costs are? Well, you can always ask the mutual fund. Or what you do is look at the annual turnover. This is a measure of how much trading a mutual fund does. It's measured in a percentage of the amount a portfolio turns over every year. So think about this, folks. If a mutual fund has 100% turnover, that means within 1 year they will have bought and sold all the securities, stocks, bonds, whatever, short-term investments in the mutual fund. If it's a 50% turnover, that means it would be 2 years. 200%, 6 months. Now, we are looking, in my humble opinion, for mutual funds that have lower turnover, because when they have very high turnover, they're not really investing, they're trading, they're speculating. They don't want to own a stock, they want to rent the thing. And so we will find that turnovers of 20, 25, 30%, that means they own it for 3, 4, 5 years on average, are decent. The lower, the better in general. But then you'll come across a mutual fund that'll have 400% or 300%. You'll say, what's going on here? Well, if it's a stock fund, that means they're buying and selling every 2 or 3 months. But it might be a money market mutual fund, in which case that makes perfect sense. Why? Because if you hold securities that mature in 60 days or 90 days, right, of course you're going to turn it over 3 or 4 times a year because it's just the nature of the securities. So in our one assignment, we're going to ask you to find the turnover. And it's sometimes a little tricky, sometimes it's not. It depends on the mutual fund. But it's there. Just got to dig. The lower, the better, all things being equal, and they never are. Slide number 23. The eternal debate. Load versus no load. Do you want to pay a sales commission or do you not want to pay a sales commission? Well, originally all mutual funds were sold through brokers and the commission was how the broker was paid. Along came companies, mutual funds that decided to bypass the brokers, and they were traditionally sold directly to shareholders, and those were no-load funds. And so you'd think, well, shoot, I'd much rather have a no-load fund than a load fund. Well, sure, but if you're going to want the services of a financial representative, advisor, wealth manager, whatever you want to call it, brokers. Why do you think they call us brokers? I don't know. You're going to have to pay for it, right? Nobody works for free, and would you really want them to? So we'll see how the industry has responded to the black eye that load funds have gotten, the sales commission, and it turns out that you can wind up spending a whole lot more in fees if you purchased a no load versus some load funds because of what? The annual operating expenses, of course. We have to look at the total fee structure. Now, here's where it starts to get a little tedious. So please have a notebook or the study guide with you, because we're gonna hold you to these, folks. You need to understand these. The original mutual funds, as we said, were load funds, were front end load. They would charge you a commission when you bought the shares. They are now typically called Class A, although some companies call them Class 1. Typically, they're called Class A shares. The commission is paid when shares are purchased. You normally have lower annual operating expenses in perpetuity. I like that word. I love that word, in perpetuity. So as the industry evolved and brokers had to compete with no-load funds, they created a new class called Class B, a back-end load. The commission is paid when the shares are redeemed. Well, wait a minute. What difference does it make, Mr. Broker, Ms. Broker, if I pay an upfront fee or a back-end fee? Oh, sit down, relax. Let's explain. Most back-end load funds have what's called a contingent deferred sales charge. Isn't that a great word, contingent? Say it. It feels good in your throat. Contingent. Contingent deferred sales charge. What does that mean? Well, the contingent deferred sales charge declines to zero over 3, 4, 5, 6 years. So maybe the first year the contingent deferred sales charge is 5%. Well, then the second year it would be 4, 3, 2, 1, and then after 5 years you wouldn't pay any back-end load. Does that make sense? Yes. Yeah, I think it does. Normally, the back-end load funds pay higher annual operating expenses, though, through those 12B1 fees until the contingent deferred sales charge declines to zero. See, they're going to charge you one way or the other. In the front end load, they're hitting you with a commission right off the front. But in the back end load, assuming people hold on to their funds for the long term, which is what you should do, folks. You're buying a mutual fund. It's a 5-6 year commitment at the lowest. You're not locked into that, but once you've made your decision, it's a good idea to let the fund do its job. It's a long-term investment. And eventually the Class B shares revert back to the Class A shares. Now why would you want that? Because the Class A shares have lower annual operating expenses, as we'll see. Okay, now, people said, well, I don't want an upfront fee. I don't want a back-end fee either. So the brokers, we respond and we create broker no-load funds, but they're not allowed to be called broker no-load funds anymore because the SEC says what you're doing is simply putting the load and into the 12B1 fees and amortizing it, which means stretching it out. So now they are load funds. They are typically called the Class C shares. They have no front end, no back end commissions. Well, they'll hit you with a 1% charge if you take the money out within 1 year, but you're not supposed to do that. That's not what mutual funds are for. However, right, no upfront fee, no back end fee. The Class C shares have higher annual operating expenses in perpetuity, or at least for a long time. Sometimes up to 10 years, again through those 12B1 fees. Hence, they can wind up costing you more than the Class A or the Class B shares over time. And so the Securities and Exchange Commission said, now wait a minute, guys, gals. All you're doing is just taking that front end and back end load or back end load and just stretching it out over 10 years or whatever. So if the 12B1 fees are greater than 0.25%, 25 cents for every $100, then the Securities and Exchange Commission says you can't call it a no-load fund. None of this broker no-load stuff. No. Oh, darn. What do we do now? We got to soak our clients. We have to charge for our services. Slide 26. We've created no-load funds, no upfront fee, no back-end fee, lower annual operating expenses, sometimes called clean shares, and we give them the name of Class F or Class I, financial advisor, investment advisor. Sometimes you see Class FI, financial investment advisor. Sometimes you'll see advisor shares. Well, what happens? Sure, no upfront fee, no back-end fee, and lower annual operating expenses. How's the broker getting paid? Well, the broker then adds a typically 1 to 2%. I've seen it, it's been lower now for some companies that are not giving you as much personal service to manage the account. We're not your brokers. Oh, no. We're your wealth managers. It doesn't sound like a lot, 1 or 2%, but over time, it will kill you. Yes, it will. And we're going to see a wonderful example of this in one of the ancillary presentations, so stick with us. And then the last share class are often called true no-load. Now, we put that in quotes because it's not a real class share, but that's what the financial media calls them, and the journalists and the talking heads on the internet and television. The mutual fund company deals directly with the public. Again, the Securities and Exchange Commission says that you may not have a 12B1 fee greater than 0.25%. And these are the darlings of the popular media. Bypass the middleman. Who needs a financial advisor? Just buy my book or sign up for my newsletter. $50 a month. But that does not mean that the overall fees are low of an individual mutual fund. Over time, a no-load fund can wind up costing you more than a load fund because of the annual operating expenses. So again, we need to look at the total fee structure of the mutual fund. And that's exactly what we're going to do. Slide 27. This is a well-known mutual fund. It's AB. I wish they hadn't done that. Remember we talked a little bit about Alliance at the very end of our presentation? Yes, our previous presentation. Alliance is a very good mutual fund company, but they got tarred and feathered because two other people in the entire organization were playing hard and loose and fast with the rules. They didn't do anything illegal, but certainly unethical. And they got tarred and feathered and almost disappeared. Then they merged with a company called Samuel Bernstein. I forget the exact name of that company. So they were called Alliance Bernstein, which is not the easiest thing to say. So they changed their name to AB. I don't know if that... yeah, I don't get paid much they only ask for my opinion on marketing, but I don't think AB is the best name for a company, AB. But they have some dynamite funds, folks. And the large cap growth fund is one of their best. They have the class A shares. Now, when you pay, say, $100, put $100 into purchase $100 worth of the shares, invest $100. If you go with the A shares, you'll have a financial advisor who will be recommending his or her recommendation, giving to you his or her recommendations on what you should invest in. And you'll pay 4.25%. So if it's $100, that's $4.25. If it's $1,000, that's $42.50. If it's $10,000, $425. If it's $100,000, no. Once you hit certain breakpoints, the percentage goes down. That's why you see the words maximum sales charge. You might pay none if you have a ton of money. And so we need to look at individual situations. Usually we don't see these reinvested dividends charges or deferred sales charges for A shares or redemption or exchange fees, so they're all none. Now here, this is the one-time fee that you pay when you invest. Here are the annual operating expenses. Every year, they're going to charge you 50 cents for every $100 you have in the account to manage the fund. These are the people with the top hats that go knocking on the doors of the companies, their competitors, their suppliers, their customers, their bankers, and research the company and decide which companies they want to own. The 12B1 fees, there's the distribution and the service fees, 25 cents. For every $100, and then the other expenses, the website, the lights, the rent, all the other things, the marketing materials. I'm sorry, that goes in there, right? 11 cents. 11 cents. So every year they're going to hit you with 86 cents on every $100 you have in the account. Does that sound like a lot of money? Well, it's actually fairly common for actively managed funds where the individual money managers are making the decisions on what to buy and sell. It's a whole lot less than what your bank or life insurance company is charging you on every $100 you put in the account. But you don't see those fees, do you? No, because the banks, the life insurance companies are not required to disclose the fees. Where are these fees disclosed? Well, they're disclosed in the prospectus. And we'll discuss prospectuses later on. So do you think people actually read the prospectus? Yeah, right. Notice that it says, okay, so that was the Class A shares. So you go to your broker, Ms. Broker, Mr. Broker, I don't really want to pay an upfront fee. And what does your broker say? No problem. It's always no problem, dear students. For you, we have the Class B shares. B, back-end load. Well, wait a minute, Ms. Broker, Mr. Broker. What difference does it make if I pay an upfront fee or a back-end fee? No, sit down, relax. Let's explain. There's a maximum deferred sales charge of 4%. But next year, that's only if you take the money out in year number 1. If you take the money out in year number 2, it's going to be 3%. If you take the money out in year number 3, 2%. In year number 4, 1%. And then after 4 years, there's no back end fee. It's a contingent deferred sales charge. And you're going to leave the money in for the long term, aren't you, Mr. and Mrs. John Q. Investor? Oh, yes, Ms. Broker, we want to leave our money in for the long term. We're long term oriented. So, no back end charge. Cool. Well, what are the annual operating expenses? Well, there's the 50 basis points. You'll hear them use the word basis, the phrase basis points. 0.5%, 50 cents for every $100. But then look at what happened to the 12. Look at what happened to the 12B1 fees. They went from 25 cents to $1. That's how the brokers are getting paid. Exactly. The other expenses are a little higher, and so from the A B shares, we see that we've gone from 86 cents to $1.66. And in the case of Alliance, that lasts for 6 years, as I remember. I think that lasts for 6 years. And then they come back and become A shares. Now notice we X'd out the Class B shares. Why? Well, the Class B shares got some very bad, they call it optics now, very bad reputation for being abused by brokers. And so companies started getting rid of them, and that's exactly what Alliance did. You can no longer invest in the Class B shares. So you go to your broker, I don't want an upfront fee, I don't want a back-end fee because, who knows, I might take the money out in a year or so. So what can I do, Ms. Broker? Oh, no problem. You see, it's always no problem. I hope you've realized that. No problem. Sit down. For you, we have the Class C shares. No upfront fee, no back-end fee. Well, if you take the money out within a year, we're going to hit you with a 1% fee, but don't put it in. If you need it within a year, don't put it in a stock mutual fund. Put it in a money market mutual fund, which they don't have this. They don't have these back-end fees, the money markets. So yes, you're going to leave it in for at least a few years, 5, 6 years, because there's stock. This is a stock fund. Okay, so no upfront fee, no back-end fee. 50 basis points, 0.5%, 50 cents for every $100 you have in the account. There's the 12B1 fees, and these last for 10 years. Yeah. The other expenses, 0.11, so $1.61. Ms. Broker, I don't want to pay an upfront fee. I don't want to pay a back-end fee, and I want to have low annual operating expenses. No problem. You're getting it. You're understanding. For you, we have the advisor class, sometimes called Class F, sometimes called Class FI, Class I. No upfront fee, no back-end fee. Look, lower annual operating expenses than the A shares. Cool. But we'll charge you an extra 1 or 2% for the rest of your lease. What was that, Ms. Broker? What did you say? We'll charge you an extra 1 or 2% for the rest of your life in perpetuity. Wait, what's going on here? Well, look, the brokers have got to make a living, right? And so they say, we're not your broker anymore. Oh, no. We're your wealth manager. We're going to charge you a fee, a nominal fee for assets under management. But it doesn't take a genius to figure out that if you add 1%, that's 1.61%. That's going to eat up this 0.86% fairly quickly. The 4% you paid up front, you're going to wind up paying that in about 5 or 6 years, and then after that, you're getting charged a whole lot more every year. If it's a 2% fee, and I've seen it as high as 2%, you're going to eat that upfront fee in 2 years, 2.5 years. So I'm not a big fan of the advisor class shares, but that's what you're going to see now over and over and over again, because that's the way the industry has gone. They've decided, people don't like to pay that commission, so what are we going to do? We're going to soak them forever. Now, if you're a broker, you'd love that, because if you keep your clients happy, you're going to make a whole lot of money. And this debate has been going on for a couple of decades now, and it really changed in earnest about 10, 12 years ago. And I'll tell you a little story. I was at a seminar somewhere, I forget, in town, in here in San Diego. And we were all suited up. I was wearing my suit, unusual, but I do wear a suit every once in a while when I go to these things. And we got on the topic of the commission-based Class A shares versus the Class F shares, the advisor shares, or whatever you want to call them, the assets under management model. And I remarked, I said, I don't really think it's in the best interest of our long-term clients to charge them this 1 or 2% fee. They're going to wind up spending a whole lot more, assuming they're buy and hold investors, which is what I want as my clients, and that's what I am. And this guy looks at me, and of course he had perfect teeth, perfect hair, beautiful suit, a lot more expensive than my suit. And he said, "What are you worried about? You send them a bottle of wine on their birthday, you take them to the steakhouse, take them golfing. They'll love you." Usually I'm not at a loss for words, dear students, but that time I really did not know what to say. I just shut my mouth and said, I'm not going to convince this guy, because obviously he doesn't care how much they spend. And you have to remember that most brokers are going after people who are very, very wealthy. So again, what do they care? They're already very wealthy. But I don't think it's in the best interest of the clients. I don't have any clients that have these assets under management. If they wanted to do that, I would explain to them, show them, have them take BUS123 and see the long-term costs that they will incur. And as I said, there's going to be, if you're walking through Canvas, you're going to see it, and if you're on the website, you're going to see it, and a presentation to show you the effects of the Class A shares over time and the Class F or advisor class over time, and they are dramatic. Okay, let's take a look at another mutual fund, slide 28. This is the Growth Fund of America, another excellent mutual fund that's been around for decades and done well in good and bad times. And notice that their Class A shares have a higher maximum sales charge, 5.75%. So that's $5.75 on $100, $2.88 if you put $50 in. Again, once you get over, I think the first break point is 25,000, then it goes down, 50,000, 100,000, it starts going down. We're going to see the break points in a future slide. But notice their management fees are less, 0.26%, 0.26%, 26 cents. There's the 12B1 fees, the other expenses. So these guys are charging you 64 cents for every $100. It's not that much lower, but over time it does add up. Notice that they got rid of their Class B shares. They start at 5%, 4, 3, 2, 1. And again, the 12B1 fees, exactly. After 8 years, these shares revert back to the A shares, and you get the lower annual operating expenses. But for the first 8 years, you're paying 1.41% or $1.41. Notice that they too have gotten rid of the Class B shares. They don't want them anymore. The Class C shares, $1.39, lower than the previous mutual fund, but not that much lower. And then they have 3 different classes, F1, F2, and F3 of advisor shares. The cheapest ones are the F3 shares. They have F1, F2, and F3. And notice, no upfront fee, no back-end fee, and very low, 30 cents. But again, you have to add the advisor's charge of 1 to 2%, 1.25. Yeah. So over time, they're going to cost you more. But you'll get a bottle of wine on your birthday, and they take you to the steakhouse, so you'll be happy. Now, here is another mutual fund. It used to be famous, now infamous, and it used to be called it was very famous as being a broker no-load fund. Oh, they're not allowed to do that anymore, right? The Legg Mason Value Trust. It was run by none other than Bill Miller, and we'll come back to Bill Miller at a future date when we look at stock investing. They did not have the Class A and the Class C shares. What they had, they called them their primary shares, the Class C shares. And they then decided, okay, well, let's add the Class A. Let's change the name of the C to the primary class to the Class C. They never issued Class B shares. So again, like the previous mutual fund, 5.75% maximum sales charge goes down as you invest more or as your account becomes worth more. 69 cents for every dollar for management fees, 12B1 fees, 25 basis points, and then 0.13, 13 cents for every $100. So $1.07, which is a lot higher than the previous two mutual funds, right? But these are relatively new, about 10, 12 years. The Class C shares, which is what they used to call them primary shares, that's what the brokers would sell and that's what they were famous for, had no upfront sales charge and almost 1% if you take the money out within a year, but you're not going to do that. It's a long-term investment. Don't do it. 69 cents for every $100, and then there's the 12B1 fees. Instead of $1, they do 95 cents. 13 cents for the other expenses, so $1.77. Now, remember, these used to be called broker no-load, and the Securities and Exchange Commission said, look, if you make this 12B1 fee more than 25 cents on $100, 0.25%, you'll hear people say 25 basis points, then you can't call it a no-load fund. You are simply stretching out the load over however many years, and sometimes I think these guys were in perpetuity. So I'm cynical enough to say, look, fine, let's reduce this 12B1 fee back down to 0.25 and simply move the fee up into the management. I don't think the Securities and Exchange Commission is going to allow that. I'm sure they're going to say, no, you can't pull that stunt. So I think they have to declare them in the 12B1 fee category. So there you go. Now, if your broker really likes this mutual fund and you don't want to pay upfront fees, you don't want to have the high operating expenses, they have the Class FI, Financial Advisor class. That's what the FI stands for. No upfront fees, no back-end fees, low. They're not really that low, are they? 1.17%. And then tack on another 1% or 1.5% or 2%. And now you're looking at, oh my goodness, over $3 for every $100 in the account. Now, what are these guys? Institutional. Huh? No upfront fee, no back-end fee, fairly low fees, not as low as the other two. But what, do you have to be institutionalized to get these shares? Later. Notice that Legg Mason, which is now owned by Franklin Templeton, right? I think they bought them last year, has since changed the name of the mutual fund from Legg Mason Value Trust to ClearBridge Value Trust. Why did they do that? Well, we'll see later. It's called burying the evidence. Slide number 30. Now, for something completely different, any Monty Python fans out there? The Vanguard 500 Index Fund, now available only in Admiral shares. This is an index fund. We've already made a quick mention of those, and we'll discuss these in detail as we go along. They don't do any research. They don't have people with top hats. They simply buy all the 500 stocks in the Standard & Poor's 500 index, which we will discuss in detail in our next chapter. But it's just a list of 500 companies, folks. It's traditionally the 500 largest companies based in the U.S., although it's changed a little bit over time. That's the idea. Big companies based in the U.S. The term for this is passive management, as opposed to the previous three mutual funds, which were actively managed. The people in the top hats made decisions about what to buy and sell. and when to buy it and when to sell it. Whereas the index fund, passively managed, simply looks at a list of stocks or bonds, if it's a bond fund, and buys them. You or I could run this fund, assuming we could read. Index funds are usually true no-load mutual funds and usually, but not always, have very low fees. Yes, be careful. In your 401k, 403b, the insurance company, it's usually an insurance company, but sometimes it's a brokerage firm, will sneak in index funds with very high fees. The big jerks, why do they do that? Because they can, because most people don't understand how they're being charged, which is why you're taking this class and you're going to be the financial guru, the investment guru, and you're not going to let those big jerks with the three-piece suit and the $200 haircut snow you over. No, you're not. The previous version, the non-Admiral shares, had an expense ratio of 14 cents. But look at this guy. No upfront fee, no back-end fee. 4 cents. 4 cents they're charging. That they should, because they're not doing anything. They're just looking at a list of stocks and buying them. They don't have any 12B1 fees. Well, they do. If your if your account has $10,000 or less in it, they'll charge you $20 a year. Unless you sign up for electronic delivery, which then makes running the fund even cheaper. And then the other expenses, 0.00, I think it's like 0.00 something or other, so it doesn't show up. So basically 0.04 cents they're charging you every year on every $100 in your account, as we said. And now for something completely different. Lower annual operating expenses. That is what an index fund can offer you. And now, Fidelity said if you can't beat them, join them. Vanguard pioneered low-fee mutual funds and was able to overtake Fidelity as the #1 mutual fund company. Fidelity for decades was the #1 mutual fund company. What did Fidelity do? They responded by eliminating all sales loads, creating their own index funds, and lowering their fees below Vanguard. Look at this. 0.015%. In other words, a penny and a half for every $100 you have in the account. Again, they have a low balance fee. If your account is lower than $2,000, they hit you with a $12 fee. And then the other expenses are less than, statistically significant, so they don't even show up. And so you have 0.015, 1.5 cents for every $100 you have in the account. In fact, Fidelity is a very smart marketing organization, by the way. They have a few of these index funds that have no fees. Now, wait a minute. How can a company stay in business not charging their customers? Well, for you marketing fans, it's called Loss Leader, the Loss Leader. And you might remember Fry's. They're basically gone now, but what they would do is they would advertise in the weekly newspaper or online and say, hey, we're going to sell you this power strip for $1, and that's just to get people in the door. And they take a loss on the power strip, and they put the power strips right next to this 99-inch television sets, hoping that people go, ooh, look at this. And so that's what Fidelity's doing. Fidelity's saying, okay, we'll take a loss on these few, I think it's 3 or 4 maybe, mutual funds, and we'll expect that most people will decide, hey, Fidelity's a good company, let's try their other mutual funds, and that's where they'll make up the difference. How low can you go? Well, you can't go lower than 0, right? I guess you could. No, let's not go there. Pay people to put their money with you. Okay, slide number 32. So now, included in the prospectus, along with the last few slides, or several slides that we looked at, are examples of dollar costs over 1, 3, 5, and 10 years. So we're hearkening back to the AB Large Cap Growth Fund. And we see that if we put $10,000 away in a 5% hypothetical, meaning, just for example, investment, 5% return every year, the A shares in the first year are going to have much higher fees. Why? Because we had to pay that upfront fee right off the bat. We had to pay that 4.25%, yeah. So $425 on $10,000 investment. And the B shares and the C shares and the advisor class shares don't have that upfront fee. After 3 years, the difference between the A and the B and the C shares is much less. After 5 years, it turns out, right, look, the B shares wind up costing us even more, and the C shares are not far behind. And after 10 years, the B and the C shares have now eclipsed that upfront fee that we paid with the A shares. In fact, if you do want the B or the C shares, you have to sign somewhere saying that you understand, you have been apprised of the situation, that you're going to wind up spending more with the B and the C shares. Now, the advisor shares look pretty darn good, right? Look at that. A whole lot less than any of the other three. But don't forget that the advisor typically adds 1.25, 1.5%, 2%. So that could easily add an additional $1,300, $2,600. Yeah, to the total cost over the long term, which is the best deal if you believe you need the help of an investment advisor. The A shares are still the best deal in my humble opinion. Now, I get a lot of blowback for that. I get a lot of people get angry at me for even saying that. And they say, how dare you? What is the matter with you, you traitor? Because, by the way, which shares are the most popular with brokerage firms these days? The advisor class, the F shares, the I shares, whatever you want to call them. Assets under management, wealth management fee. Slide 33. Here's the Legg Mason Value Trust. We see the exact same situation. The A shares cost us more upfront, but after 10 years, the C shares, the primary class as they used to be called, wind up costing us more. The financial intermediary shares are less, but remember we have to add another $1,300 or $2,600. And then the institutional look like the best deal, but how do you get them? Well, for starters, are you a large pension fund, a university endowment, or a tax-exempt charity? And oh, by the way, do you have at least $1 million to invest with us? Yeah. Now, again, index funds should be much cheaper. The old investor class was charging 14 cents for every $100, and notice that was $180 over 10 years. But the new Admiral class shares, $51 over 10 years on a $10,000 investment. So, if you go with index funds, be very careful that you are not being sold high-fee index funds. Who would do that? Who would sneak in high-fee index funds into their retirement plans? Southwestern College? And it's not Southwestern College because Southwestern College doesn't administer their 403B plan. When they first came to our campus, two guys from FBC Retire, LPL Financial, whatever, I forget what company it was. And they didn't have $3,000 suits on, folks. They were kind of schlumpy. And they had a PowerPoint presentation with 70-some slides. The presentation was 45 minutes. They had no idea what they were doing. I felt kind of sorry for them. But I'm looking at the materials. They didn't realize they had a ringer in the audience, right? And I'm going, wait a minute, what is this Galtmore or Gartmore? I forget the exact name. 500 index fund with 90 basis points, 0.9%. And then all of a sudden their eyes go, oh, we're sorry. Yeah, we're going to be replacing that. We're going to be replacing that. They replaced it with the nationwide 500 index fund, which I think 60 cents, 6.6%. And I kept telling the folks at Southwestern that in the human resources, the benefits, the payroll department, we're getting screwed. We're getting screwed. I mean, I didn't, because I didn't choose them. I didn't choose the index funds, and they didn't understand. And finally, one of them said, "Well, I'll take your class." And when she took the class, she said, "We're getting screwed." I said, "I told you, I told you." And so, and it was Nationwide Insurance that was behind the whole thing. They were the ones who were behind the whole thing, and then eventually it's become Great Western or Great West Insurance Company, and I'm not part of the plan anymore. I moved all my money out of it because you have to wait until you retire to move your money out of it. So I moved it into my own account after that. So I haven't really followed it in the last few years, but they're not alone. I'm not trying to attack Southwestern specifically, but it's just typical that the insurance, it's almost always insurance companies, folks, that do this. But sometimes brokerage firms do it too. So be careful. Watch out for high fee index funds. Do you remember the exchange traded funds that we discussed? They often have lower fees than the index funds. The ETF from Vanguard that tracks the total U.S. stock market has an expense ratio of 3 cents for every $100, 3 basis points, 0.03%. And as we said, Fidelity now has 4. Now that's 4 index funds that have 0 annual fees. How do they make money doing that? Well, they don't until you or their clients decide that they're going to try some other mutual funds that have fees. Okay, now let's take a couple of slides and take a look at some of the other things that we discussed previously. And the first one is the breakpoint sales reductions. We're taking a look at the Growth Fund of America. We said that they had a 5.75% maximum sales charge. But once you reach $25,000, whether you purchase or accumulate, whether your account becomes over $25,000, it then goes down to 5%. At $50,000, 4.5%. At $100,000, 3.5%, 2.5%, 2%, 1.5%, until finally, when your account becomes $1 million or you have invested $1 million, you pay no sales charge. You think the industry likes the high net worth individuals, rich people? Yes, we do. We prefer, in fact, some brokers, when they find out that my favorite thing to do is to get somebody to start putting $50 a month away in a Roth IRA, they just shake their head and think, oh, this goofball. Yeah. This guy. I'm very happy, I get $1. The Class A shares qualify for a sales reduction if you invest a larger amount or as your investment grows. Now, some brokers, you don't do this anymore because they'll fine you, take away your license, and make you pay back to the investor what you stole from them. Some brokers would fail to inform their clients of this feature. Instead, as the client approached the break point, the broker would advise them to start another fund. When I heard people were doing this, I said, oh my Lord, why did they do that? Sure, most people are not going to understand, but then 1 or 2 of them are going to figure it out, and then your name is mud. Your reputation is destroyed. You should just pack it in. Well, now you don't have to worry about that because the Securities Exchange Commission will hit you over the head with a fine. They'll take away your license, and they'll make you pay back what you screwed out of the end client. And then there's the contingent deferred sales charge for the AB Large Cap Growth Fund. First year, if you take the money out, 4%. Second year, 3, 2, 1. And after 4 years, you don't pay any back-end sales charge. That's why we call it a contingent deferred sales charge. And oh, by the way, you may have heard of annuities. We'll discuss these later on. Annuities from life insurance companies usually have this same type of situation. They call it a surrender charge. But they don't start at 4 or 5%. They start at 20 or 25%. Yeah, yeah, right. Yeah, don't trust insurance companies with your investments, folks. Remember, I'm also an insurance agent. I'll tell you the truth. Slide 37. Okay. Oh, now, now that you know everything you need to know, almost, about share classes, and you're going to go back over and study this because that's learning. Learning takes repetition, unless you're one of the very few people, well, actually about 10% of the population. Once they see it, they have it. They don't have to review it. I ain't one of them. Now that you know everything about the Class A shares, the B shares, the C shares, the F, the FI, the advisor class shares, where are you going to put your money? I'm going to give you $10,000 10 years ago. Will you choose the AB Large Cap Growth Fund or the Growth Fund of America with the Class A shares, knowing that the Class A shares are cheaper over time? How about the Legg Mason Value Trust with the Class C shares, the formerly primary class shares, which the A shares weren't? I think they were available just about 10 years ago, so I need to fix this, I guess. Or do you want to go with the Index 500? You couldn't get the advisor class shares with $10,000 10 years ago, so you had to go the investor class shares, which they've gotten rid of now. You used to have to have $100,000 to get the advisor shares. Now with $3,000, you can get the Index 500 shares. And we'll compare that to the Standard & Poor's 500 index, which is often the benchmark for large companies, mutual fund, large cap, they call it large cap mutual fund companies that invest in stocks in the United States, big companies. So which one? $10,000. Which one are you going to choose? Well, dear students, fees are important, but they certainly do not tell you the whole story. When comparing mutual funds, you must look at many attributes, not the least of which are the rates of return, preferably over long time periods. And people say, well, 10 years is long enough. And I say, no, it's not. I want to see how well they've done over 20, 30, 50 years. Yeah, I'm long-term oriented. Now notice, the Large Cap Growth Fund from AB, as I said, it's a very well-run fund. Your $10,000 became $52,500 at an annual rate of return of 18.04%. Yeah. The Growth Fund of America did pretty darn well, turned $10,000 into $41,500, 15.28. But look at the Legg Mason Value Trust. It trailed the other two badly. The Index 500 fund almost did as well as the Standard & Poor's 500 index. Well, that makes sense. It's got to pay a little bit of money out because they got to run the fund. They got to get paid. So an index fund won't match the index, but it should come pretty darn close. So with an actively managed fund, you run the risk of underperforming the benchmark, the standard by which the mutual fund is measured, but you also have the opportunity of doing better than the index. And again, we're going to discuss the controversy over whether or not these people are actually earning their money. Notice that if you had these at NAV, if you had $1 million to invest, you would have made even more money. You would have gotten 18.55% from the Large Cap Growth Fund and 15.97% from the Growth Fund of America. So if you believe you need the services of an investment advisor, which shares are you going to go with? The A shares, and you're going to look at the long-term investment results. In fact, the last 10 years have been very unusual. We'll discuss this in our next chapter when we discuss the difference between what is typically called growth investments and what are typically called value investments. Typically, over time, they balance one another out. The last 10 years, 12, since the global financial crisis, growth stocks have clobbered value stocks, literally clobbered them. And there are many people who are saying, oh, that's the way it's going to be forever. And there are other people saying, oh, no. There's going to be a day of reckoning. We'll see. Cool. Okay, so now it's time for checking for comprehension. Get out your A, B, C, D cards. What are shares that do not have an upfront sales load? Instead, they assess a decreasing back end load if you withdraw your money within 6 years. The annual operating expense is higher, courtesy of the 12B1 fees. Are these A, B, C, or the F or the I shares? They're the B shares. Remember, back end load, B shares. They normally eventually become A shares after 6 or 8 years and get the lower annual operating expenses for after that. What are shares that do not have an upfront fee and only a 1% back-end fee if redeemed within a year? Your advisor called them broker no load, but you notice that the annual operating expense is higher than the other share classes, again, courtesy of those ubiquitous, you like that word, ubiquitous, 12B1 fees. Ubiquitous means kind of like they're everywhere. A, B, C, or F shares? Right, the C shares. They will charge you that extra annual operating expense through the 12B1 fees for 10 years and then revert to the A or the C, and sometimes they don't revert. Your financial advisor tells you that these shares have no sales fee, a very low annual operating expense, and she mumbles something about wealth management. These shares are A, B, C, F, or I shares? Yeah. The correct answer is D. She also did her best not to explain to you that her brokerage firm will charge you an extra 2% each year, but she'll send you a bottle of wine on your birthday and take you to the golfing course. Oh, by the way, there are dozens of other share classes depending upon the mutual fund company, but don't worry, all of the other share classes that you will encounter are simply variations on the 4 main themes that we discussed. The A, B, C, F, FI, advisor class. And so you are prepared. You are ready to go into that 401k meeting where the guy in a 3-piece suit is going to try to snow you and sell you mutual funds that have high annual operating expenses, and you're going to shoot him down, and he's going to go, and all your colleagues are going to turn around and look at you and say, wow, are you smart? Where did you learn that? And then what are you going to tell them, right? Business 123, Introduction to Investments, we wash your back, you wash our back. We are so proud of you, dear students. Get ready, because in our next presentation, we're going to do our best to get our arms around this 800-pound marshmallow that is the mutual fund industry. It ain't easy. Please study, bring honor to Southwestern Community College, your friends and family. We are very, very proud of you.